Section 1. The Fearful Year. Welcome to the 2026 recession. We find ourselves in the year 2026. The economic winds have shifted. A chill is in the air. Around the world, the word on everyone's lips is recession. Financial news channels are a constant drumbeat of worry. Flashing red arrows, alarming headlines. Many people are feeling the squeeze. Companies are tightening their belts. Boardroom conversations, dinner table conversations. In times like these, the natural instinct is to pull back, to protect what you have, to wait for the storm to pass. A time defined by uncertainty, and above all, by fear. Fear drives selling and pushes prices down, even for strong companies. Section 2. The core idea, what buy the fear really means. The phrase buy the fear is simple, the psychology behind it is profound. It is not a call for blind gambling, it is a disciplined investment philosophy. The price you pay is a key determinant of your future return. When prices are low, the potential for future gains is higher. Prices get low when fear takes hold. When crowds believe tomorrow will be worse than today, logic and long-term planning give way to emotion and short-term survival instinct. People sell after a fall, even if long-term prospects haven't changed. Mass selling creates a cascade, pushing prices below true value. A buy-the-fear investor sees a sale, not a crisis. A great business doesn't become bad because its stock fell 30%. This is not about calling the exact bottom, no one can do that consistently. It's about recognizing widespread dislike and lower prices. Commit to a process. Buy quality at discounts and wait for fear to subside. Section 3. Opportunity knocks. Why downturns can be a friend to the patient investor. Recessions are painful and hardship is real, but for a 10, 20 or 30-year horizon, downturns can be powerful allies. Prices are lower, public companies go effectively on sale. You're buying future earnings streams at cheaper prices. Lower price means more shares for every dollar. That arithmetic magnifies future gains on recovery. Economies expand and contract, markets fall and recover. History shows repeated recoveries to new highs, though never on a smooth path. Long-term upward trajectories are driven by innovation, population, and progress. Downturns refocus attention on value over hype. Ask, is this durable? Real customers? Real cash flow? Recessions separate fleeting trends from lasting value. Here are 6 clear reasons why buying when fear is high can work. First, lower prices. Panic can push great companies below intrinsic value. Lower price means higher potential return and wider margin of safety. Second, markets recover. Own the rebound by buying the downturn. Patience unlocks this advantage. Third, higher dividend yields when prices fall. Reinvest to accumulate. Fourth, recessions reveal quality. Focus on balance sheets and durable moats. Fifth, a long-time horizon turns volatility into an advantage. Finally, rules-based buying brings discipline. Act when others panic. This framework forces systematic, rational action. End of section. Thinking about buying when everyone else is selling is one thing. Actually doing it is another. You need a plan, a simple framework to act rationally, not a complex algorithm, just steps anyone can follow. Invest responsibly, eyes open to opportunity and risk. Step 1. Check your personal finances, emergency fund first. Keep 3 to 6 months of essentials in safe savings. Never invest money you might need soon. Step 2. Focus on resilient, mispriced businesses, or use broad index funds. Step 3. Buy in parts on a schedule to lower average cost. Step 4. Commit to 5 to 10 years or more. Write it down. On scary days, follow your plan, not your feelings. Abstract concepts are useful, but simple numbers make it tangible. Let's apply the framework in a hypothetical 2026 scenario. Alex has a secure job, an emergency fund, and $6,000 to invest over 6 months. Alex sets $1,000 on the first of each month into a broad index fund. Month 1. $100 per share, 10 shares. Month 2. $90, about 11.1 shares. Month 3. $80, 12.5 shares. Months 4 to 6, 85, 95, 110. Total, $6,000 becomes 65 shares. Average price, about $92.30, below both 100 and 110. Systematic buying lowers cost and positions for recovery. Embracing buy the fear is not ignoring danger. Prices can fall further and stay low for a long time. If your horizon is 5 to 10 years, a 2-year slump is temporary. If you need money in a year, it's a disaster. Individual companies can fail. Too much debt, poor management, broken models. Mitigate with diversification. Broad market index funds and ETFs spread risk, so one failure won't sink your portfolio. The greatest risk is your emotional reaction. A predefined plan and automation are your lifelines. We're bombarded with headlines, designed to trigger fear and greed. Media sells clicks and ratings, not calm wisdom. Filter the noise, focus on business health and long-term data. Be an investor in businesses, not a speculator on price wiggles. Zoom out. Jagged peaks and valleys exist within a persistent upward trend. What felt like the end then looks like opportunity in hindsight. We stand in 2026 amid uncertainty. The instinct to retreat is understandable, yet fear creates opportunity for long-term thinkers. Periods of pessimism are often the best times to plant for future wealth. Discipline to buy while others sell creates potential for outsized returns. Secure your finances, diversify, buy systematically, commit to the long run. Turn volatility from an enemy into an ally. There will be no instant gratification. Patience is paramount. Trust your plan more than headlines or fleeting emotions. Start small. Stay consistent. Seek simple, trusted advice if unsure. Sensible, disciplined steps taken now can carry you beyond the memory of the 2026 recession.